Hello and welcome to the Weekly Market Metrics. I'm your host Sandeep Rao and we are in week 22 of 2026. And that brings us to the end of this May month. We are 5 months down in 2026 now. This week the big story again was Iran, and for once it came with a positive twist. There seems to be a possibility of peace. Trump tweeted over the weekend about an impending deal and the oil price dropped over 10% on Monday alone. And Brent crude, which was above $100 just a few weeks ago, ended the week near $92. For India, where we import 80% of oil which comes through the Strait of Hormuz, that's a meaningful relief. Talking about the rupee, which had slipped to 97 last week, has found some ground this week, closing in at 95. That's it. Trump himself said it was too soon to sign anything, so we are back in the wait and watch mode. Coming back to India, in the background, the government of India seems to be acting and the PMO is coordinating across ministries to boost foreign fund flows, with the finance ministry working on relaxing some rules and a proposal to cut taxes on foreign bond investors. And for the markets, well, Nifty closed at 23,548, down 0.72% for the week. HDFC Bank was in the news for the wrong reason midweek, and yet Bank Nifty ended up mildly positive at 0.35%, the second strongest index of the week after Midcap Nifty. That's markets for you. So with that, let's get started with what happened last week and what could happen in the coming week. Starting with rate of change across indexes, well, in the last week of May, Nifty and Sensex ended in the red at minus 0.72% and minus 0.85% respectively, while Bank Nifty and Midcap Nifty managed to be in the green at 0.34% and 0.65%. Looking at the final scorecard for the month of May, except for Midcap Nifty, all three indexes closed in the red. Midcap Nifty gained 4.7% for the month, while Nifty lost 1.87%, Bank Nifty 1.14%, and Sensex took the biggest hit, down 2.78%. It's a very similar story when you look at the YTD returns. For the year 2026 so far, Midcap Nifty stands out as the only index with positive returns after 5 full months of trading, with Nifty, Bank Nifty and Sensex down 9% to 12%. Given that it's end of month, let me take you through the monthly seasonality chart of Nifty. As I just shared, May 2026 finished in the red with a drop of 1.87%. This means we have now seen 4 out of the first 5 months of the year close in red. As I always do, I looked at the historical data over the past 27 years. 4 red months right out of the gate in the first 5 months has only happened 4 other times: in 2004, 2011, 2020 and 2022. And if you look at the final returns for those specific years, they ended up plus 11%, minus 25%, plus 15% and plus 4%. The final yearly outcomes are mostly positive, and that could also be because markets have had a positive drift for a very long time. And if you look at the data set, it's still just 27 years, so not really a large data set for us to make any statistically valid conclusions. Talking about the month of June, well, June has historically been a positive month for the markets, carrying a win rate probability of close to 65%. If you look at it from 2020 onwards, we have seen only one single negative close for the month, which happened back in 2022. The other 5 years have all finished in the green. So while I'm skeptical, I'm still hoping for a positive close in the June, but you already know my track record with predictions. Now let's look at Nifty on the different time frames, starting with the weekly time frame. This week, Nifty lost 172 points or 0.72% to close at 23,548, which lands it below all the key weekly moving averages, specifically the 10, 20 and 40-week SMAs that we track. Nifty largely remains completely stuck in a broad 1,350 point range between 24,600 and 23,250, which is about a 5.5% corridor that we have been consolidating inside for the past 7 weeks now. The weekly range expanded from last week's 543 points to this week at 605 points, while the 10-week average now sits at 794. In fact, Friday's daily candle alone had a massive range of 518 points, which is the highest we've seen in the recent past since April 2nd, when Nifty made its recent swing low of 22,183. Does this tell us anything structurally different happening with the index? I'm quite skeptical because mostly the final and the chaotic drop in the last half hour of the trade could have been because of the institutional flows in and out because of the MSCI rebalance which happened. Moving on to the daily time frame, well, last week's price action on a daily time frame was so confusing. I'll show you what I mean. As I said earlier, last week Nifty failed to cross above the critical 23,800 resistance level. On Monday, it managed to open gap up, but the next 3 trading days, Tuesday, Wednesday and Friday, were all red days, completely erasing every bit of the gains made on Monday. Friday did the most damage to the charts, giving up almost 1.5% in a single session. On the daily time frame, Nifty is yet again trading below its 21, 50 and 100-day EMAs, as well as the 200-day SMA, just like the last week. Well, Nifty did close above the 50 EMA on Monday, but after that it was unable to sustain the momentum and fell right back below the 50 and 21 EMAs. On the hourly time frame, Nifty managed to stay above the 50 EMA following the gap up on Monday, holding it all the way until the second half of Friday. But by the closing bell, that late sell-off dragged the index down, causing it to close the week below 50 EMA. Talking about Nifty monthly expiry, which happened on Tuesday, May 26th, with a 205-point range on the expiry, it was a relatively easy expiry. After an up move in the first hour of the trade, the index went on to make lower highs and lower lows. Directional sellers as well as time-based straddle sellers who had their C stop losses alive during the first hour spike could have comfortably made some money. Do let me know in the comments how your expiry went. Moving on to what to expect in the coming week. After being stuck in that tight 500-point range between 23,300 and 23,800, Nifty did briefly break out of it, but Friday's massive move dragged the index right back inside that old sandbox. Now, the broader range we are staring at has expanded to 24,100 on the upside and 23,250 to 23,150 acting as a support on the downside. That is a wide 850 to 950 point range that we are looking at. And because of this, the overall bias remains bearish to sideways, which is very similar to what we discussed last week. Looking at the straddle premiums to gauge the expected range for the upcoming weekly expiry on Tuesday, 2nd of June, the Nifty at the money straddle closed at 319 points, up from 286 points last week, implying an expected move of roughly 1.36% on either side. This gives us an expected range of 23,867 on the upside and 23,229 on the downside. If we go back to last week's straddle pricing, the expected range was 24,000 to 23,430 and Nifty did close at 23,914 on the monthly expiry. It stayed within the range, but holding a naked straddle and trading it is never advisable. Looking at the directional bias of Nifty, Bank Nifty, Midcap Nifty and Sensex, it is exactly the same setup as last week. Midcap Nifty remains firmly positive on both short and medium term time frames, while the other 3 heavyweights are deeply negative on both short and medium term trends. Moving on, to India VIX fell 9% this week, closing at 16.19. For a brief moment, it did manage a daily close below 15 mark, but Friday's sudden spike dragged it right back above 15. However, if you look at the bigger picture, the broader trend of India VIX is clearly on a downtrend. What this tells us is that the market may no longer be deeply worried about the larger macroeconomic uncertainty, and maybe this is the new normal. Moving on to the sectoral index performances this week, let's look at this week's top 5 TJI index performers. We have communication equipment, city gas, wires and cables, QSR and plastic pipes. Communication equipment is a standout, up 9.5% this week, 21% over the month and sitting right at its 52-week high. This definitely doesn't look like a one-week story. Something clearly has been building here for a while, and it features both in the top performer list and the 52-week high list this week. And that double appearance is worth paying attention to. Wires and cables is the other clean story, strongly positive across every time frame, just a whisker below its 52-week high and with a good breadth behind it. These are the two sectors I would keep a close eye on. QSR is making a comeback as it was in the last week's top 5 as well, and the 1 month number is at 6.7%, suggesting something may be quietly building up in the sector. But compared with wires and cables, which has stronger numbers across different time frames and a cleaner chart, the QSR is clearly the weaker of the two, worth watching but not worth chasing yet. Talking about City Gas, it looks more like a bounce rather than a trend. It's up 9% on the week, but sitting at 12.8% below its 52-week high and negative on a 1-year basis. Talking about plastic pipes, again a similar story, a decent week, but the long-term picture doesn't yet seem convincing. Now moving on to the 52-week high view, there are two indexes which are sitting right at their highs: Pharma Small Cap and Communication Equipment. Now notably, both pharma indexes are in their highs simultaneously, which signal genuine sectoral strength rather than just the large names carrying the weight. Bearings also continues its quiet steady climb, multiple weeks near the top of this list right now. Again, there seems to be some story here worth digging into. Compared to the last week, the only overlap in the top 5 weekly performers is QSR, but in the 52-week high list, bearings, pharma and communication equipment are all carryovers, and as I always say, continuity across the weeks is an awesome sign. These aren't just random 1-week bounces, and as always, if you are looking at picking stocks, make sure you check across multiple time frames and watch the breadth before you take your pick. That's pretty much on the sectors this week. Moving on to commodities, well, on the daily time frame, Gold M briefly dipped below the 50 EMA on Friday before quickly pulling back up, and it's now hovering around it. Same story with Silver M, which found support at the 50 EMA on Friday and is holding around that level. This week I want to highlight a commodity we don't track regularly here, but one that has been doing quite well over the year, and that is aluminium. The weekly number is almost flat, up 0.39%, so nothing exciting happened this week, but zoom out and the picture changes dramatically. Aluminium is up 6.3% in the month, 23.6% in 3 months, and 37% in 6 months, and nearly 50% over the year. That is a serious sustained move, not some kind of a spike or a blip. A large part of this is due to the global supply chain story, with aluminium being a critical input for EVs, defense and infrastructure, and the supply constraints that have been building up in the metal for a while. For those of you who are keen to explore this further, there's a recent piece on oilprice.com about the serious and prolonged supply outage the aluminium market is facing right now. As always, the links are in the show notes. Given this performance in aluminium, we may start tracking this more regularly going forward, but for now it's worth keeping on your radar. If we look at our usual commodities that we track on a weekly time frame, it was a mixed week across commodities. Gold and silver both slipped slightly down 1.6 and 2%, while crude had the biggest move, dropping 7.4% on Iran peace talk hopes. Natural gas, on the other hand, was the lone gainer, up a whopping 8.4% for the week. But zoom out to the YTD numbers and the real story becomes apparent. Crude is up 76% for the year, natural gas up 161%, silver 133%. Now these are not normal times, otherwise you won't see these numbers. So that's pretty much it for the commodities this week. In summary, the markets ended May on a volatile note as a sharp Friday sell-off wiped out the early gains, fueled by late institutional rebalancing. While tentative global peace talks dragged crude oil down and gave the bleeding rupee a much-needed breather, the broader macro backdrop remains highly strained. The other thing which we've been observing is the massive divergence across market caps, with mid and small caps outperforming the benchmark NIFTY and Sensex. If we look at the option prices, well, we expect an expanded range in the coming weeks, so do watch out for any possible volatility in the coming week. Bottom line, my overall bias continues to remain negative to sideways, just the way it was last week. Moving on to what caught my attention this week, well, I've got 2 recommendations for you this week, and they both happen to be about India's past, just in very different ways. The first is a long form piece from Alter magazine titled The Making of Indian Statistics. It's a story of Prashanta Chandra Mahalanobis, the man who essentially built India's statistical infrastructure from scratch. How he created the Indian Statistical Institute, pioneered the National Sample Survey, and gave a newly independent nation of 350 million people the tools to see itself clearly through data for the first time. Beautifully written and very relevant given how much we rely on India's economic data today. Also sad in some ways. If you read it, you'll know why. The second is a documentary titled Mohenjo-daro: Unsealing an Ancient Indus City on YouTube by harappa.com. It's a 37-minute film that walks you through one of the world's greatest lost civilizations. In this film, Omar Khan, the filmmaker and the founder of harappa.com, returns to the ancient city to share his reflections from his 52-year journey with this great historic metropolis. Awesome watch if you are a history buff like me. As always, the links are in the show notes. Now over to the events to factor in for the coming week. Looking ahead to the next week is a 5-day trading week with no market holidays. The main event for the week is on Friday, June 5th at 10 a.m. when RBI announces its interest rate decision right during market hours. So do expect volatility around the announcement and keep your risk managed. Oh yes, and those of you who are working, you can look forward to your salaries being credited. Okay, I was just kidding on that one. Back to the events for the week. Well, other than the RBI event, there are no major known events for the week. And that's it for the week. And with that, we wrap up this week's weekly market metrics. If you find the series useful, don't forget to subscribe to the channel and yes, do share it with your friends. Until then, stay steady and stay curious and enjoy your weekend.